Hey guys, I'm here together with Andre Crabb. And Andre is a guy behind the scenes when it comes to Tradingview. And together with Andre, we have developed the Tradingview indicator of the expander, but also for the other strategies coming up. And in this video, and also in in the show, we like to discuss how to use that one. And first of all, to introduce you to Andre and to get to know that one who is really working on the code and is always there for, well, trading you magic. Welcome, Andre.
Yeah, thank you, Wielands. Hey everyone, my name is Andre. I'm the software developer behind the expander strategy here. So Wieland has his strategies and I just make them a reality.
Oh, it's awesome. And I really love to work with them because it gives some great signals. Of course, sa having one thing said just right now, a signal alone is not everything. Of course, the market needs to
Mhm.
follow that one to the end. So just to make this clear, we're gonna do some magic, but of course, magic happens always through the markets and not just because we have a signal. Can we agree on this one?
Yeah, of course. It's not just the signal, but you got to know how to trade the signal and
Right.
follow what the market's going to give you.
Yeah, exactly. I mean, in general, it has a name like hit rate, and we always have to be aware of hit rate means also the other side of the coin is the losing rate, which means you have a hit rate of, let's say, 60%, which means you have 40% of not hits. And when it comes to
Mhm.
signals and to strategies, it's always something to figure out that we have to have quite a good hit rate, like 50% plus and also a good follow through, which gives us a good risk reward ratio. And we are working on this, Henry, all the time to make it perfect for the trading view, for the expander, and also therefore for the people to use it. And right now, let's go into this and let's discuss the expander and see first of all what the expander is about. I'd like to share my screen right now.
Yep.
So, for example, I have the chart here. It's a 5 minute chart of the ES. It's the S&P 500 future. It's a mini future. We have a 5 minute chart right here. And what I have in the screen is the expander tool. And as you can see, we have some signals coming in. We have some very nice and decent signals. And also we have some signals which are quite lame, like right here. So that really something you would like,
Every strategy
yeah,
is
you
going to
would
have
like to
that.
consider to trade. Oh, oh wow, we have discussed about that one. You see this? The W.
Oh yeah.
So we
Yep.
are working on this one as well.
That's to come.
It's a double touchdown strategy, so it will follow as well. But let's talk about the expander first. We have here a signal right now, and this one is quite nice. You see the breakout, and then it's not having any follow through at all. It's like 2:30 European time. It's like 8:30 Eastern time. So market
Mhm.
is pre-open and shoots like a rocket. Done, done, done for the day. High of the day, and clearly then price went down a bit, and market participants really couldn't do this. So what we have right here is the signal of the expander strategy. So what is the expander strategy basically?
Yeah.
In general, I like to look at two components for a strategy or for that strategy. Number one is I'm looking at the candlesticks. I really love the candlesticks because they give me the impression what really is going on in the market. Basically, it's what you could call price action trading. So you see really the price moving up and down. You see some formations, but what I really like to look at with the candlesticks is the candlestick body in comparison to the upper and lower shadow. So like all the wicks we see. And if you put this together, it gives you quite good insights about how strong buyers or sellers are and where, some change of power might happen also. For example, if you look here, you see market is going up like 1, 2, 3 periods, but you see that buying is weakening. I make it a little bit bigger. So for example, see buying is weakening. You have like prices shooting up, but already people are selling. Trying again, shooting up, but people are selling again. Prices shooting up, but people are selling even more. and you see that the body of the candles are getting smaller and smaller until there's nothing left of body anyway. It's like, just some bones left over there. Just a shadow. And this
Yeah.
is where
Yeah.
reversal comes in. We call this one a shooting star. I mean, this is more a doji shooting star, maybe a gravestone doji, but it all comes to the same, which is selling pressures coming in, buyers are losing steam. And what happens afterwards is a sell-off. It's not a guarantee, obviously, it cannot be, but it's just, an observation over the years, over the centuries, because candlesticks coming from the 16th century already used in Japan. So therefore, it's really an old technique, it's an old observation, how prices just move and change direction. People are losing steam, either buyers or sellers. And you can spot the reversal just by looking how, well, how buyers and sellers are behaving. Who is having power, who is losing power, and where is the change happening. So we can see this right here, for example, and there are different formations. We have things where you just see this wick, the upper shadow or the lower shadow. You can have formations where you can see maybe, let's take that one. Here's a lower shadow. This is called a hammer. I like that one. So you have like quite a big red candle, and then you have a green candle coming into the body of the previous one, just like, pushing the sellers away. And I like this as well. This is also a reversal signal. And if you put things together, it's also a false break, which is even better. So this is something I really like to look at. So basically, that's why I love the candlesticks, and that's why I always look at the candlesticks to see where's a change of power, number one, and to see also where really the reversal might happening at that very moment, or in the moment then I'm waiting for. But also what I need is something else, and this what you see here is it's the indicator. And this indicator is the Bollinger Band, or these are the Bollinger Bands. Developed by John Bollinger in 1983, by the way. So quite old already, 40 years plus, but still very valid, still very, very good to use. And it gives me an impression if a price is overbought, oversold. Like if an asset has gone too far in its price movement, if a reversal is alike. So that's something what I like to look at. And what you need to know about the Bollinger Bands is that they are measuring a standard deviation from the price's average. So if the price moves too far away from its own average, it's likely to be overbought or oversold. And if it's coming closer to its own average, it's likely to bounce back. As we can see here, this is the average 20. So the middle line here is a simple moving average 20. And as we can see, price moves to that one and it bounced back at least a bit, quite often, as we can see, right? And this is just random somewhere in a 5-minute chart of the S&P. So we can see this all over in charts. And you see this is quite nice. It drops, it reverses back to the simple moving average 20. It reverses in that area, sells off again, reverses again to the simple moving average, and sells off again, and so on and so on. It's quite nice to see. And also there's a strategy together with this one. I call that one, it's a touch and turn, and it also will be added up over the time to this indicator. So this is how I like to look at the markets. And when does the expander come into play? The expander has the idea to combine both. So looking at the candlesticks and bring them together with the Bollinger Band. So this means whenever a price tends to go into the direction of the upper or lower Bollinger Band, I like to consider them as overbought and oversold, like John does, of course. I mean, he invented that one. And by looking at the candlesticks, I see that, or I like to see that the reversal I'm waiting for, because the price is overbought or oversold, that the reversal already is in place and happening right now in this very moment. And this is what happens here, for example. You see the price moves high like crazy, gets sold off a bit, goes into correctional mode, tries to go up again, not really making it. And then you have this signal. And the signal is like, it's a dark cloud cover, by the way. So, and then you get, from definition, dark cloud cover formation outside of the Bollinger Band. There's a high, that's a prerequisite. And then you see that you have, with the signal, a potential of a move of 2.19 risk-reward ratio. This means you get a little bit more than 2 of your risk. It's like 1 risk and 2 reward, and a bit more depends on the slippage and whatever comes here as well. So how to use that one? Basically, if you get a signal like this, what you can do is having the definition of an entry in that case, and this one is the low of the formation, and the stop loss sits right above the formation, right here. And my in general profit target, number 1 is the middle of the Bollinger Bands, if it makes sense. In this case, it doesn't, because it's already there, already too close. And the other one is the other side of the Bollinger Bands. And this gives you a risk-reward ratio of, well, you see, 2.
It's off the, I think the stop is a little too far.
It's too far, right? Let's see. Yeah, here it is. And something like this. Yeah, you see.
It should be at the, yeah, I think it should be at the top of the wick for the stop. It looks a little too far.
Where is it?
It's hard to see because the dotted line is right on it, you know? There you go. 217.
And that's why you need some kind of automation. But I don't want to push it too far. I think the idea is quite clear. So yeah, we already cover it. So if you get the signal and you see, okay, it's 2.19, basically it's a potential. But as we also can see, what does the price do afterwards? You get the signal, you entry, so you reach the simple moving average 20, so the middle of the Bollinger Bands, and then the price pulls back a bit, and you already got into the red zone with your trade and almost got stopped out. That's why it's very important to have the right stop loss, right? So you see, you already almost got stopped out. So people tend to get very nervous in this situation. So therefore, it's very important also to trust a strategy if you use one, right? Because otherwise you would like go and make trading mistakes. But as you also can see, this is quite a good entry to follow the whole down move if you want to. So therefore, if you use a strategy, you need to trust it. And also you have to go really with the right stop loss, which is the high of the formation, and you have to leave it where it is. So that's also very important. And then you see price goes up again, but then drops not to 2.19. As the price is moving sideways here, the bands tighten a bit. And as you can see, what we reached here somehow is a risk-reward ratio of 1.7. So what you need to know first about the strategy is it's related to the Bollinger Bands. And the Bollinger Bands are moving. As the average is moving, the standard deviation is moving, the upper band is moving, and also the target zone is moving as well. Sometimes in your favor, sometimes not in your favor. So that's basically the deal. But why is this important? In general, why I really like this is because people always feel like, oh, I have to have that very far away target. And now they wonder why it never got reached. And the answer is quite simple. It's never got reached or rarely get reached because the market does what the market does. It just moves. And you can have targets like crazy far away, but the market doesn't care. The market just moves in its own pace. And as long as you don't want to sit in a trade forever, you just need to follow the market's move, period. And the Bollinger Bands are perfect to cover this. Do you have a high volatility? The bands widen up and your profit target is a bit far away. But perfectly fine because the market has a high volatility. And if the market doesn't have a high volatility, but a low volatility, the bands tighten and you get earlier out of your trade, but for a reason, because there's no volatility. And if you don't have any volatility, why should you do a trade, right? So therefore, the Bollinger Bands for me are perfect. To answer this question, and this question I'm pretty sure everybody has in his head, is, where do I take my profit? And always it's a hassle. And you can use several measurements to do so. But I like the Bollinger Bands, even though, and see how nice it is. The bands are reached, so coming from one side, going to the other side, and then you have to pull back already again. So all the profit already is gone. So it makes really sense to take the profit and go over maybe with another strategy, which is right here, the touch and turn. You go like with trend following, and then you can use that strategy. Now, what else do you need to know? You see that hammer here? I like to use a stop entry. So this means you get the signal, and you feel like, okay, let's do this. You put your entry as a stop order, stop entry order, stop buy in this case. You put that one in your system, in your software, and then you wait for the market to reach that level. I want the market to prove me the seriousness of the next move. I don't want to be shopped around and just get drawn into a trade because of fast moves. I want to really some kind of seriousness. And you see why it's important? If you have your stop entry right here, you never got filled for a reason, because this is just, let's say, an intermezzo, right? So just one correctional move and then the drop continues. So if you just jump in, you got stopped out immediately. Fair enough, that's why you have the stop loss, but maybe you want to avoid that one and use the stop entry. So also this is very important to understand and to know. So you might have this one as a winning trade already. You might have this one here. It's the same situation, by the way, just coming from the other side. You see, you have some kind of double top, you have some kind of double bottom. So quite nice. And then you have here the expander signal as well. Just a bit, let's say, you see how close it is. Just maybe a point or something like this, but still it's valid. And then you can just go also with a stop entry. You just got stopped in, gets a bit choppy around the middle line, and then you exit right here. And also what you need to know about the strategy, and also this is important to understand. Yes, the market might move higher or might move lower a bit, but we're talking about statistics. And the statistics are that according to the Bollinger Bands and the mathematics behind, which is the bell curve, is that if you're above or below 2 standard deviation, which is the setting of the Bollinger Bands, chances that the price reverses above or below are like 90%. So that's what it is. And therefore, I like to exit at this area. And that's why I like to entry right here with this situation, because chances to reversal are like 90%. And chances for reversal right here is the same. So that's why I like to exit here and have this as a profit target. And as we can see, it's quite nice to have this. So price is moving quite a lot of times between the upper and the lower band. And if you can catch some reversals between those, you might come out quite well. So that's basically the idea. And also you see you have some high volatility, you have some low volatility. And honestly speaking, if you have really low volatility, you don't want to do a trade at all. Not that one or any other one, because you don't go anywhere with this one. You want to see something like this, right? So you want to have high volatility, and maybe you want to have this one. And then it's up to you as well if you want to manage a trade, if you want a re-entry. But basically the idea is to enter with a signal as a stop entry and exit at the other side of the bands, having the option to exit at the middle of the bands with some part of your position, if possible, not really here, but if you would consider this a signal, you could exit here, for example. So that's basically the idea of the expander strategy itself. And I'm very happy with it. I worked on this for years and I really tested it like several time frames, a lot of assets. And it's really good to go in stocks, in indices, in crypto as well. You can use it on commodities. You can use it also in Forex, but Forex, you need to know a little bit more. But I will cover this one later on. First of all, Henry, what do you think about the strategy?
Yeah, I love how your focus is on the statistics, right? Because, like you said, the market is going to do what the market is going to do, and it's not going to care about where you want your profit target to be.
Nah,
So,
nothing.
yeah, being a software developer, I'm very logical and numbers rule everything. And what's cool about Bollinger Bands, like you said, is that it's focused on statistics and the bell curve and the standard deviations.
Mm,
So, it has a high probability of staying within the bands by definition. The
yeah.
tricky part, as you mentioned, is everything moves. Your target moves, the bands move, and of course, price moves.
Yeah,
But
but
you
it's like
learn
life,
to.
right?
It's
Something
it's just like life. Yeah,
everything is in a
of course.
flow.
Everything's moving all the time, and you got to learn to capitalize where you can, when you can.
Yeah, yeah. I mean, the problem always is when you look at the markets, everybody's trying to catch like the big move with trend following, which is fine once in a while, but most of the time it's quite a pain. And you see this here as well. If you do this classic, all the breakouts, yeah, you might be fine right here, but then you see if you don't exit at a certain point, you find yourself in a losing position again, and you're going nowhere because prices move down, they move up, they move down again, and you're going crazy, and you sit in this trade forever if you don't get stopped out, and you end
Yeah.
up nowhere. And this is something I really considered for myself for a long time. For like, why I'm not doing trend following like everybody's talking about. And the reason is simple. It's not working for me, at least for me. So because I'm not the guy
Mhm.
sitting in a trade forever. I know there are people who love trend following, and yeah, of course, it works if you're the type of guy. If
Yeah.
not, you feel like, oh my God, why am I losing money all the time? Because you have a profit, then the profit is gone. Then you're in a loss. Then the loss is gone, you're back in profit. It's like you're getting shaking up like crazy. And and that's why I love the Bollinger Bands. I'm very grateful for this because they give me a clear indication of when the move is like done, statistical wise, in
Yeah.
general. What is the expectation? It moves from here to there, done. That's the expectation. So I want to go with that stretch, done, right? And
Mhm.
this is how I like to play the markets. And also, yeah, sometimes you have situations like this. Look at that one here, which are really lame. I don't know even what this is. But also, you see this one. It's like some kind of spinning top, stop entry. Nothing really happens. No trade. You have this one, which is a hammer, stop entry. Depends on how close you are. And when you delete this order, you might not get stopped in. Maybe you get stopped in. You see, it just goes just 1 point or whatever above, and then drops. But fair enough. You have one losing trade, but look at this very small candle, and yeah, so you might end up with a losing trade. But you see that the potential of what you might get and what you risk is always quite nice. Same here. Let's see what we have here. It's a Harami. Stop sell would be underneath the formation, never filled, not a big deal anyway, right? So that's very important. That's why I really recommend going with stop entry orders, because if you jump right in, you might end up in situations you would never go into normally. So yeah, this one is a nice one. It's not a signal because of the definition, because when we discussed how to do the programming, we were talking about some prerequisites, how to do this and what to put into as a prerequisite, that everything is a signal, but really the good ones are a signal. And this one from definition is not a good one because of that candle here. It has a high, a low, then we have a higher low, then we have a lower low again. So it's not really something I would call a stable move like this one. This one is a good move, but it's somewhere in between of nothing. Yeah.
Yeah, that's the tricky part, which we've discussed a few times, right? Is you have to draw the line somewhere. You have to make some decision about what is and what is not valid according to the
Yeah.
strategy.
Yeah.
So the
Yeah.
code is very exact.
Yeah, and it needs to, but it also means that sometimes you miss something like here. And
Sure.
this might be something where you have not the perfect definition, because
Mm-hmm.
if you do programming, you need exact definition. Let's say, what is the definition of this uh, dark cloud cover? And it needs to be exactly right here. And if something is missing, it's not a signal. So the algorithms, the software says, no, I don't see it that way. And that's the difference between like you sitting in front of your screen, knowing a little bit more, and also, all the context you're looking at. And if you're like, of course, it's a signal. It's not perfect. For me, it's a signal I enter because it looks nice, right? And also, you got a good trade out of it. But the machine doesn't see it the same way. So that's always the deal when you have automated signals. And also, that's the deal if you have automated trading. So you better know about this when you use that one. So I think for me,
Definitely.
human being always is better than the machine, but we have to invest time. And that's where that's where the signals are coming in. It saves so much time if you have some kind of a list, if you have some kind of signals, if you have some kind of pop-up or whatever. And that's what I love about that one. Can you show me how this works a bit?
Yeah, you want to dive into
Yeah, let's do this.
the
Let's share
alerts and
the
everything like
screen.
that?
Yeah, you can share the screen if you like.
I know you like the white background. I'm a dark background kind of guy.
Perfectly
For my
fine, so people see both versions.
and I just had Bitcoin pulled up. If there's something else you want to look at,
Well,
uh,
why not? It's fine.
let me know. But this is Bitcoin, very
Mhm.
volatile. Had a nice first take profit here in this one. Nothing else coming up yet, but let me see. Let me move our little windows out the way. And so we were talking about the alerts and everything. Well, let's first real quickly let's show, if someone gets access to this or any indicator that you might get access to, you want to come to your invite only section of indicators down here. And when you type in the name of what you're looking for, in this case, the expander, then this is where it's going to show up.
Mhm.
And when you click on the name of the indicator, it's going to add it to your chart just like that. Very
Nice.
easy. They should always be in that same place, especially you want to favorite the indicators that you want to use because it makes them a lot easier to find. So to add an alert, these, as Wieland said, right, this indicator, the code is looking for a specific combination of candlestick patterns with the price action with the Bollinger Bands. And that's going to draw a little label, a signal on the chart whenever those criteria are met. Ideally, you don't have to be sitting at your computer all the time, and you want to get notified via some alert whenever a signal happens. So
Mm.
let's look at how to add one. There's a few different ways. Basically, we need to bring up the alert window, create alert. And one way to do that is by coming out to the alerts sidebar and hitting plus. You can also right click on the indicator itself and say add alert on expander. So that's a little easier. And what we've done is we've named the signals either bullish or bearish. So you want to have the condition be the expander, and then the name is, or the action, right, is expander bullish or expander bearish. There's all these other ones, price could be crossing up or down or something like that. But for the signals that come directly from the expander indicator, you want to select expander bullish or bearish.
Mhm.
And then the trigger, usually you want to do once per bar close. Because as Wieland was saying, you want a little bit of confidence after the close of the signal of the bar. Maybe you have a stop entry, for example. If you say once per bar, then the conditions could be met in the middle of the bar, and then they become false at before the bar closes. And so you could get that alert before it actually was a validated signal. So that would be a false positive if you do once per bar. So once per bar close means that only after the bar is done, based on whatever time frame you're looking at, that's what's going to determine if it's a signal or not. So you're adding some confidence when you do once per bar close. And then you can name this whatever you would like. You can name this expander bullish on, let's say, just BTC, and you can have whatever message you like. And then the notifications, this is where the fun happens. So you can notify in the app. If you have the TradingView app on your phone, which I recommend people do, because you can create alerts, you can view charts on there pretty easily. You will receive a push notification. It tells you right here in the mobile app. So you could be going about your day, have the conditions be met, check real quick, or have a stop entry in place, and then you'll get in if it matches all the criteria that we're looking for. It doesn't happen automatically, like you said. There's always got to be that human component. Like automatic trading can be very dangerous, but
Yeah.
you have the signal from the expander. You get the notification in your pocket, and you hear that signal. You can go ahead and take a look. A toast notification. This is showing on the app if you're already looking at the screen. So if you're already looking at your chart, you would get a little notification down here. They call it a toast because it comes up and then it goes back down. And that would be the toast notification. You could also do an email if you wanted to. You're probably not going to look at your emails quick enough to be able to receive a signal, for example, but you could have some text message carriers. You can use an email address to send a text message to yourself.
Yeah.
And so you could use the email. I guess it has to be what's specified, but you could have alerts on your email.
Yeah, maybe you can do this, if you go for weekly charts, you get on the weekend, you get the
Sure.
signal, right? So
Yeah.
you get all the weekend, like at Friday night or Saturday mornings or whenever, this happens, you get a bunch of emails done. Not all the pop, pop, pop on your
Mhm.
mobile, just get the emails done. I like that one.
Yeah.
But of course, if you go like minutes chart, it's a disaster, right?
And that's what we were talking about a little bit before we started recording too, is you choose, the signals are separate from the strategy. And if your strategy is day trading, then an email is going to be too slow. But if you like to swing trade, maybe
Yeah,
if you're looking at the daily chart rather than the 5-minute chart or something, then yeah, something else could be just fine.
right.
You can send a webhook, which is something that people might use if they want to do something a little bit more algorithmic or get fancy, or send that somewhere else. If you're a developer or if you have some other app built for yourself, then you might look into that. Most people don't need the webhook URL. And then a sound or a plain text. There you go. Sends plain text to an alternate email. Here we go. And this is where you can enter a different email address, and you can maybe get like a text message, for example. So if we just show, the toast notification, notify an app, we'll call this expander bullish. And when we create that, it shows in our list of alerts over here. So we know now if I come here that there's, I have an existing and active signal or an active alert on this. And the settings, the expiration is open-ended. So it's never going to turn off. So you could have and this depends on your TradingView subscription type. Some subscriptions have a limited window of how long you can have an alert. So free accounts have a limitation, but if you have a paid account, I think of a certain level, your alerts never expire, and so you can have the expander alerts running all the time, 24/7, 365 days a year, and you can always get notified. And so if you want to have a few different let's say you have a watch list and you want to look at, I'm just going to keep looking at crypto. Let's say ETH and here. Here's a nice one here. Got to take profit one. Low volatility over here, so not great, but we got some midline hits for sure. This would have been a good one. Same thing, right click, add alert. It already defaults to, the ticker you're looking at, the indicator we're using, the expander. You just have to say once per bar close, give it a name, hit enter, and you're done. And now you've got your alert. So it takes 10 seconds to add an alert. It's very quick, very, very quick. Yeah. Was there anything else on the alerts, Wieland, that you wanted us to go through? Of course, I don't know if I showed it. If you like to play both sides of the market, there's the bearish signals as well. So you can always play both sides.
Yeah, so this means you always have to have a signal long, a signal short. So you have to enable both. Right.
Oh, and that also just wanted to mention, you can see here that the alert is set for the time frame that you set. So I just changed to the daily time frame, but the alert is still active and running on the 1 hour time frame. So you could set ETH on the 1 hour, ETH on the daily, ETH on the 5 minute, and you can have it notify you, and it tells you in the pop-up in the app, whatever, which one it was. So you always know what you're trading.
Right. So basically this means I don't have to have all the open charts. I just need that list. Depending on my subscription, it's limited, might be limited or not. But I mean, basically, there are always some special offers, and they're quite good from Tradingview. You definitely need to mention that one. So, for some Black Friday deals or whatever coming in, you save a lot of money off a subscription. So definitely worth looking at it if you want to go a little bit more, deeper into all the analysis mode and also doing more charting. But in general, so you need just to do the alert list, and you can go through all the time frames. So let's say you just want to go with Bitcoin, or just want to go with the S&P or the DAX, or just with Apple, or what do I know. So you get all the alerts and all the time frames, and you get it as you go without sitting in front of your screen and without, having to do anything but just watch the message coming in, say, hey, we have a signal. Of course, you need to know what the signal is about. So you need to check always, is it a good one or not a good one? So I recommend this one. And then you're good to go. You need to do your calculation, of course, about your position sizing, about your risk management, everything else. But that's normal. That's what traders do, right? And also, what I really love about TradingView, you can log in into your broker. You use that signal. You use that indicator. You get the signal, and you get the signal on your mobile. You can do everything while having a coffee somewhere. And honestly speaking, for myself, this is key because I hate sitting in front of my computer. I like to be outside. You know what I mean? Traveling around, being all the nice places. I hate being on my laptop. And this is a game changer. That's why, I'm really happy that we found each other to make this happen.
Yeah, I'm all about that freedom of lifestyle.
Right.
For sure. If you can be traveling the world, if you can be just not going to an office every day, like that alone is a win, I think, for a lot of people. To live life on your own terms. And if you can make an income this way, it's life-changing.
It is for sure.
Yeah.
And again, so first of all, what you need to know about also about TradingView, it's not fully automatic. It's just a signal. Done. And it's good because there's still
Yeah.
some responsibility of being a trader because it's your money on the line, right? So therefore, take over responsibility. Get the signal. Make sure you like that signal. It's also the responsibility of a trader. And well, do you all the calculation, do your risk management, and then basically the job as a trader is done. The rest is up to the market. You cannot do anything. The market follows through or doesn't. It's not on us. That's a problem. Unfortunately, that's not what we can control. All we can control is how much money we can afford to lose, and we want to put into the fire. There's nothing other expression. How much money we want to put into the fire if the trade is a loser. That's what we can control. But we cannot control if the market just follows its signal. How can we? People need to understand this a lot, by the way, I think.
Yeah. Yeah. One of the things I liked from one of the videos of yours, Wieland, is you say you just take what the market gives you.
Right?
Because you can't control what the market gives you, but you can control what you can control, which is your strategy around the signals, the
Exactly.
entry, the
Exactly.
stop loss, the take profits. That you can control.
See, I I have this philosophy, and a lot of people get this wrong. I have the philosophy that the strategy needs to follow the market, not vice versa. And there's a lot of truth in it. But people try always to force it differently, that the market needs to follow the strategy, but it will never happen by accident. But unfortunately, it will
Yeah.
never happen. And that's why it's so important. And that's why also it's important to exit this trade if you're like in statistical limit, let's say like this. And even though it might move more, but this is one of the rare occasions, rare situation where really the follow through is going more. But then you can turn over to another strategy, doing some trend following entries as well. You're always open to do this. There are more
Yeah.
strategies, of course, to apply, but the expander for me works very well if you follow some basic ideas. And these are really basic, not really complicated.
Yeah. Yeah. I love that. Did you want to go into some analysis or look at some other sectors? I kind of showed some crypto. I know
Yeah,
you
yeah, let's
mentioned some
let's do
others.
this.
I can
Let's do
stop
this.
sharing and you can take back over.
Go. Right. So this is euro to the US dollar. So we're talking Forex. And randomly, it's just 4 hours chart, but it's not really important because if no matter what time frame you use, signals and all the movements are quite the same. So we could also go randomly like 5 or 3 minutes. Doesn't matter at all. So what you need to know about Forex is number one, Forex in general over the long run is trending. So this means as it follows economical rules, let's say stability of economic zones, of countries, of currency zones, whatever you want to call it. And also it follows the differences of interest rates. There's not really a change coming up all of a sudden. So this means it follows some kind of trend within some some area of movement. And this is true. Let's see, if you look at, for example, the weekly chart, you see it's clearly trending. If you go from May 21 back to September 22, this is
Yeah.
a downtrend by definition. And now, if we go from January 23 to, let's say, September 24, and even like the end of 24, it's a clear sideways trend. So, what to well, what to watch out for, and what you need to know about trading forex with the expander. You see that if it's and as it's very trending, follow through is not really happening. If you see, you have this reversal, and this reversal is more or less just a correction. So you don't have these swings you are looking for, right? So you don't have these ones. What you have is something which is not really profitable. So you have just like here, you have just a down move it gets corrected a bit, and then it follows just the down move. So this means if you go against the trend, and that's especially important to understand for Forex, don't expect too much profits. Expect more losing trades. So therefore, that's why I recommend more just going, if you get a signal, always go with a trend. So probabilities are much higher to have a winning trade. And therefore, this means that all of these trades here are not your trades. What you like to look for is you have this move, and let's say price moves right here, and you have the signal here. That's where you want it to go, right? So this is something I really need to point out. It's not that the strategy is bad and not working. It's ridiculous, right? But it's that you just need to know where and when to apply the strategy properly. And this means that if you're doing this, and it doesn't matter if you're on a weekly chart, 5 minutes, whatever chart, it's always the same. It's more trending than not trending. So basically the expander, if you have like a deep correctional move, that's good. But if you have just coming from, a bit as a correctional, you see either it's going through the time, just standing still, or just moves a bit like here, just a bit. So you don't want to do this. If it's in a trend, it's a different story if you're in a sideways market. Look. Of course, when do you know that it's a sideways market? Let's see. That's a deep correction. It's a false break. It's a false move. And therefore, you see that the trend is over, right? So goes over into sideways market. And you see it gets blocked already here. So you have 1 second block right here. And then you see also that the market is stopping at this area as well. So you have the beginning of the sideways market. So then you can watch out for signals. And this works at least going to the middle, not really to the end. So it misses some follow through as well. There's no signal, but here's a signal, and this one is valid. This one is valid. And we have some signals going here, but not filled. The next signal valid again. And also you can see as it's a sideways move, basically you get more or less exactly what you're looking for. So the exit is more or less at the same level like suggested or like the projection and the idea was right here. So this is what I highly recommend if you trade Forex to watch out for and to skip that ones who go against the trend if it's really clearly trending up or down. It's different if you have a sideways trend. See, then you can play this ping pong a bit, which is nice. That's why it's called trading range, by the way. And yeah, then you can find some nice trades. But if it's really like going strong, stay away from it. And this is true basically whenever you have in a certain asset a strong move. If people are going crazy, they are crazy and they don't want to do any correction at all. They just want to go crazy. Let them go, wait, and try to look for the signals when things slow down and look for other situations or other strategies which are coming up, which is a touch and turn, which is perfect for Forex, by the way, as you go from the middle of the Bollinger Bands and also for the double touchdown, where you have clear reversal signals that the market is reversing. And this might be a situation like here, where you see, okay, that move is done, and you're going back. So this is the expander. I can make it a little bigger. This is the expander, and all in all, it's the, see this one, it's the double touchdown, it's a reversal formation, it's the M formation, which gives a reversal. So basically, that's what I wanted to share as well when it comes to Forex. And therefore, why do I do this? Because I want people really to understand how the strategy works, what to look for, and what to take care of. Protect your assets, of course, use stop loss levels, and take your profits if they and when they appear. So that's basically what I wanted to add here. And I think
Yeah.
from my point of view, I think we already covered a lot. I don't want to go too deep into this right now and doing too much charts. We could continue with this on the other video, but for myself, I think it's already quite a lot to look at. What do you think, Andre?
Yeah. Real quick, I was just looking. I think I showed crypto Bitcoin on the daily. Uh,
Yeah, of course.
there's some really interesting uh here, I'll just do this real quick. I'll share. But share. There we go. I like looking, because you never know on an asset what the best signals are
Mhm.
going to be. And no one really knows until you look into it. And everyone's got their different style, right? But I couldn't
Yeah,
help but look at the weekly chart on crypto because we know
I
how
love it.
volatile it all is. Like, look
Yeah.
at this one, right? If this was your low, this was your stop, you would have made it to the midline.
Mhm.
You would have made that. That was a really nice trade right here as well. Of course, exiting at the opposite band, but if you held on to that one, you would have ridden that all the way.
Yeah.
As long as you would have, right? If I guess what I'm seeing here is, you could use these as looking for entries and maybe you want to hold, right? If you want to trade and exit, of course you can do
Yeah.
that. But if you want to see, okay, I know everyone's talking about the crypto hype. Well, where would I want to get in? These have
Yeah.
been some pretty solid entry points right here. All of these. This one never got stopped out, and you hit the
Yeah.
opposite band.
Yeah. I
And the
mean,
same.
you name it. It's a very important point you mentioned right here. It's called
Mhm.
expander strategy and not just expander signal. But of course, you can use it as signal
Yeah.
only and go over to your own management. I love this because when I say guys, you gotta apply the strategy one on one. Already the turtles, they have problem. It's not working. You can give people a perfect strategy, some screw, some fuck it up, and some people succeed like crazy and everything in between. So therefore, I
Yeah.
highly recommend applying your own like management style and to adjust the strategy up to your needs. But one thing for sure, the signal needs to be unchanged. That's the point. if
Hmm.
if you feel like you have to change something, let's talk. I'm always open for the better, but for right now, I feel like the signals are very nice and they give you a good opportunity to enter a certain move. And if you want to switch over to trend following, feel free to do so. If you like to do some scalping, feel free to do so because it's a personal own trading style. But at the
Hmm.
end, the idea of the strategy is to follow the swings according to the Bollinger Bands, which are just according to statistics. And it's also very important to understand. So with this, you get everything that the Bollinger Bands offer as coming from the bell curve, and you get everything that the candlesticks offer coming from the probability from the reversal signals. And then you have best of both worlds. And whatever you're up to, the signals, you can use them the way you like. And also, you mentioned going to the middle of the Bollinger Bands. I really like to add this one because maybe I just were too quick here. The middle of the Bollinger Bands is what we call mean reversion. And basically, this was the idea I had in mind when I created the strategy, is that you go from one side of the trade to the other one. And therefore, you can go for corrections, just basic price corrections of the previous
Yeah.
move back to zero, which is mean reversion, back to the own average and exit there. Sometimes you're good with
Hmm.
a good risk reward ratio, sometimes you just get a piece of it. But that's a deal. But also, there's the observation that quite often price moves forward, and goes to the other side according to the statistics. Relatively high, like overbought, and then relatively low, like oversold, and going back to overbought, like we can see always in the chart. So both is nice. And if you want to do it like, I don't know, let's see, you just exit a part in the middle and wait. Because we don't know what the price is doing. We don't know what the market participants are doing. Maybe people right after your entry go to sleep and you're the only one being left in the market. You don't know. Or they go
Yeah. You
totally
don't know.
crazy, or you go totally crazy and you feel like, wow, I'm sitting in a rocket right now. You don't know. And that's the good thing in trading. And same, it's a bad thing in trading because you just don't know. Yeah.
Yeah. Yeah. Could be for the better. You
Yeah.
could make a nice move. Could be for the
Exactly.
worse, but that's why you got to manage. Like
Exactly.
you said, put your
Exactly.
stop losses.
Right.
Yeah.
Yeah. So I feel like let's make a break here and let's continue if we have some further developments because there's coming up a lot. We're already discussing this, but we are talking about touch and turn. We were talking about the double touchdown. There's a lot of things coming up to really to ride these waves of the market, and I'm really looking forward to this.
Yeah. Sounds good, Wieland. This was fun.
Yeah. All right. So thanks for now, Andre, and let's continue later. Thanks.
All right. See you, everyone.
Yeah.